All right, next up, this one's from Shelly. Hey, Beau, I bought a mixed-use property last year with a bridge loan. The property has 5 residential units and 2 commercial retail spaces. The property is now renovated and fully leased up. I have solid financials on the property, and I am a strong borrower. I am all in on the project at $3 million, and I have a value today at around $4 million. I would like to get the best long-term debt and, if possible, pull out some cash. What would you recommend for finding the best financing for this deal? The property is in Northern California. Thanks.
Okay, so assuming that the debt service coverage ratio is 1.2, 1.3 or better, you've owned it for over a year, I would recommend on this one, I would recommend that we would go to a credit union or a regional bank. It doesn't say the location. We have a network of credit unions and regional national banks we work with, but most likely we've been having the most success working with our credit union partners, and their rates right now are far superior than most banks. So I would say our first bet would be to source it to a good credit union partner. We just closed one similar to this, a little bit smaller loan, but the rates were still relatively good. They were in the low 5s. Very short prepayment penalty, 3-year prepay. You're not getting stuck in a long prepayment penalty. Some credit union partners don't have prepayment penalties. Some of them do. But that's where I would go. I would say that if the debt service coverage ratio is in line, you're probably looking at about 75% loan to value. So if your property appraises at $4 million, right, 75% of that is what, $3 million. So you're probably not going to get a lot of cash out. I don't think we're going to be able to get 80%, maybe, but 75% seems more realistic for something like this. And I think, if everything checks out and you're a pretty strong borrower, low 5s on a 5-year fixed. Last loan we did was it was fixed for 5 years. Then it adjusted once after the 5th year, and then it was 5 years fixed again. So it was a 10-year term amortized over 30 years, which is pretty good. The longer the amortization, obviously, the less the debt payment is on a monthly basis, which means more cash flow to you. But we could dive into particulars. As always, go to bookwithbeau.com and schedule a call with me, and we can discuss this in detail. But this should be achievable. I would recommend a credit union first. And there's just a certain way to approach credit unions because credit unions are owned by the members. They don't have a strong marketing salespeople. They have loan officers, but they don't go out and broadcast to the world. They broadcast only to their members. But what we do is we build relationships with these credit union loan officers, and that's how we're able to get these deals done. Hope that helps. Once again, go to bookwithbeau.com. Thank you.